Welcome back to Investing Talk Podcast. Today we're doing a deep dive into Arch Capital Group. We've gathered the latest info to really unpack their recent performance, look into their financial health, competitiveness, and, well, the outlook. Our goal here is simple: guide you through what we've found and highlight the most important insights about the company right now. And just before we jump in, if you find this valuable, maybe take a second to subscribe, like the post, or leave a comment. And if you're feeling generous, you could consider buying us a coffee. It really does help us keep doing these deep dives.
Okay, let's start with the basics. Arch Capital Group. They're based in Bermuda. They operate globally as a specialty insurer and reinsurer.
But listed on Nasdaq, S&P 500 component too.
Correct. And their business, it's sort of structured around three main areas. You've got the insurance segment, then reinsurance that's essentially insuring the insurers.
Got it.
And also a pretty big mortgage insurance operation. Their focus, it's really on commercial lines, those specialty areas that, require specific knowledge.
Niche expertise.
That's the idea. They're quite large worldwide presence, about 7,000 employees. They even have this quote they use: "We're risk managers, innovators, always alert for new markets." Seems to capture their approach.
That focus, it definitely shows up when you look at the financials. Let's start with revenue growth because, wow, the latest annual figure, TTM, ending Q1 2025, is $18.17 billion.
A substantial number.
And up 26.13% year over year. That's quite a jump. But it's not just 1 year, right? Looking back, 2022 saw almost 4% growth.
Yeah.
Then 2023, a huge surge, nearly 42%.
42%, yeah.
And then 2024 followed up strong again, almost 28% growth.
That recent 3-year period is really telling. The compound annual growth rate, it's around 30%.
30% CAGR. How does that stack up?
Well, if you compare it to many big global multi-line insurers, they're often looking at mid-single digits over that same time frame, maybe.
So Arch Capital is really outpacing them.
It certainly highlights their focus on those higher growth areas, like you mentioned, the mortgage insurance and reinsurance pieces. Their strategy seems to be paying off on the top line.
Okay, top line looks very strong. But investors always look at the bottom line, too, earnings per share. The number for Q1 2025 was $1.48 per share.
And that's where the picture changes a bit compared to the year before.
How so?
That $1.48 is quite a drop from the $2.92 per share they recorded in Q1 of 2024.
Whoa, okay. That's a big difference. Why the decrease in just that quarter, especially with revenues looking so good?
The main driver was lower net income for the quarter. It came in at $564 million. Compared to about $1.1 billion in Q1 2024. Big drop. And looking at operations, after-tax operating income also fell $587 million versus $933 million the year prior.
So a definite hit in Q1, but you're saying the full-year trends leading up to this were still strong.
That's right. Based on the overall picture, the full-year performance has been robust. Q1 looks like maybe an anomaly driven by specific events, not a fundamental shift in the business itself.
That's important context. So if we look past that one quarter at overall profitability, how do they measure up? ROE, for instance.
Right. Return on average equity. Yes, this is where they tend to stand out. For the full fiscal year 2024, ROE was 22.8%.
22.8%. In insurance, is that good?
It's very good. It's significantly above industry averages for specialty players. Usually you might see high single digits, maybe low teens, so low 20s. That shows really effective profit generation from shareholder capital. Strong underwriting, efficient capital use.
Okay. And the other key metric, the combined ratio, how did that look for FY24?
Impressive, 82.5%.
And remind us, lower is better, right? Below 100% means underwriting profit.
Correct. Below 100% means they're making money on the insurance policies themselves before investment income. And 82.5%, that's widely considered best in class, shows superior underwriting discipline.
Compared to the industry.
Industry norms for large diversified players are often closer to 95%, maybe even 100% or slightly over in tough years. So low 80s consistently. That's a real competitive advantage for Arch.
Okay, so strong underlying profitability, but that Q1 2025 hit. Let's circle back. You mentioned catastrophe losses.
Precisely. That was the main story for Q1 25. Significant pre-tax catastrophe losses.
How significant?
The total hit in that quarter alone was $547 million.
Wow. And the main cause noted was California wildfires.
Yes. The information points primarily to the California wildfires driving that large figure. These kinds of events can really impact results quickly.
And how did that filter down into the segment results?
Well, you saw directly the insurance segment. It actually swung from an $86 million underwriting profit in Q1 24
Okay.
to a small $2 million underwriting loss in Q1 25, largely due to those cat losses. And the reinsurance segment. Its underwriting income dropped almost 56% compared to the previous year's quarter.
So that explains the lower net income and EPS pretty clearly.
It does. It shows how these major events flow right through the P&L.
It really highlights the vulnerability, even for a strong performer. But despite that Q1 earnings pressure, how did the balance sheet hold up?
That's a good point. It showed resilience. Book value per share, which is a key metric. It actually increased by 3.8% during Q1 2025.
Increased, even with that earnings hit.
Yes. Ended the quarter at $55.15 per share.
How does that happen?
Couple of things. It shows their underlying business, outside those big cat events, is still performing well, still generating value through disciplined underwriting. And also, their capital management helps. They bought back about $196 million of their own stock in the quarter.
Buybacks reducing the share count.
Exactly, boosts the per share value. And looking longer term, their book value growth has been pretty consistent over many years.
And overall capital looks solid. Total capitalization was around $23.5 billion at year-end 2024.
Solid, yes. And importantly, how it's structured is conservative. Their debt-to-total capitalization ratio is only about 15.1%.
15%. That sounds low for a financial company.
It is quite prudent compared to many peers, gives them flexibility, stability, which you need in this business. And this conservative stance is reflected in their strong financial strength ratings from the agencies, too.
Okay, so strong fundamentals, resilient balance sheet. In this competitive insurance market, what really makes Arch Capital stand out? What's their edge?
Well, they position themselves as a leader, but specifically in those specialty insurance, reinsurance, and mortgage lines. Their advantages seem to come from, one, that diversified model across the three segments that helps balance things out.
Okay.
But a key thing they stress is their data-driven underwriting and risk selection.
So using data analytics to pick and price risks better.
That seems to be the core of it, leveraging data, deep expertise in niche markets where that knowledge provides an edge, that combination of scale in their chosen areas, and this analytical approach likely explains that consistent best-in-class combined ratio we talked about. They focus where they have an advantage.
Makes sense. Stepping back now, what about the wider industry? What are the big trends affecting companies like Arch?
Well, there are definitely pushes and pulls. On the positive side, there's growing demand for the kind of specialty risk solutions they offer, and increased mortgage activity helps their mortgage insurance business.
Okay, those are drivers. What about challenges?
Challenges include potential regulatory changes, maybe impacting mortgage insurance. Technology shifts are always a factor, changing how things are sold, processed. And, broader macroeconomic volatility is always there in the background.
And the big one we saw in Q1, catastrophe losses.
That's a major ongoing challenge for the entire industry. Elevated cat losses, often linked to climate events like wildfires, severe storms. It puts pressure on everyone's margins, including Arch Capital's.
Is competition heating up too?
It seems so. Increased competition in both insurance and reinsurance markets is mentioned. Capital comes in, potentially pushes down pricing. But one point made is Arch's ability to maintain discipline outside those cat-exposed lines helps them navigate that pressure, perhaps better than some.
And briefly, the leadership.
Mark Grandison has been CEO since March 2018. Seems to have strong track record during his tenure. The wider exec team is noted for deep industry experience.
All right, so putting it all together, strong underlying business, that Q1 setback, competitive strengths, industry pressures.
Yeah.
How's the market reacting? What's the stock been doing?
It's seen some volatility, especially after that Q1 report hit. There was that dip, 2.78% on June 11th, for example.
At longer term.
Over the past year, the general trend has been upward, reflecting that underlying strength. But the last 6 months or so have definitely been more volatile, even if the overall direction was still positive.
And valuation. You mentioned book value earlier. How does price to book look?
Around 1.67 times book as of June.
How does that compare?
Well, it's below where it's peaked historically for Arch, so not at its absolute high. But it is above the industry median, which is closer to, say, 1.28 times book. The PE ratio wasn't specified, but they typically trade at a bit of a premium, likely because the market recognizes that better growth and profitability.
Right.
Also worth noting, they don't typically pay a regular dividend, and the stock's beta is usually below average, suggesting maybe less sensitivity to broad market swings.
So what's driving the recent weakness then, after Q1? It seems like investors are reacting directly to those cat losses.
It really looks like it. That Q1 earnings miss driven by the wildfires was a disappointment. Investors seem to be weighing that demonstrated long-term ability to grow book value against the unavoidable reality that these large cat events can hit short-term profits hard.
So disappointment over Q1, even with rising book value and buybacks.
That seems to be the main factor pressuring the stock recently.
Okay, makes sense. So summarizing the key considerations for investors now.
Yeah.
Risks versus opportunities. What are they?
On the risk side, number one is clearly that catastrophe exposure. Large events can still significantly impact results, especially if frequency or severity increases. Then there's sector competition could limit pricing power if things get too crowded. And potential regulatory changes, particularly around mortgage insurance, are always something to watch.
And on the flip side, the opportunities.
The consistent book value growth is a positive. Supported by those buybacks offers some underlying value creation. And if catastrophe activity moderates, or if insurance rates continue to firm up, Arch Capital, with its strong underwriting record, seems really well positioned to benefit. Their expertise could lead to improved profitability in a better environment.
Got it. Last question then. What's the general feeling, the sentiment around Arch Capital right now among analysts, maybe investors online?
Analyst sentiment, from what we see, remains generally positive. Ratings like outperform or buy seem common. They tend to point to that disciplined underwriting and the diversified business model.
And social media. Retail investors.
More mixed there. You see some people highlighting the valuation, the price to book maybe looking attractive compared to history, suggesting deep value. But others are definitely cautious, emphasizing that ongoing cat risk. Most discussions seem to be about trying to make sense of the quarterly results compared to peers. No major red flags like scandals or lawsuits apparent.
So a bit of a divide then.
It seems that way. Some see an opportunity based on valuation and long-term strength. Others are wary about the potential for more near-term pain from catastrophes. It mirrors the stock's recent volatility, really.
This look at Arch Capital really brings up a fascinating point about insurance, doesn't it? Here's a company that seems, based on the numbers, exceptionally skilled at managing the risks within its business underwriting capital expenses. You see it in the ROE, the combined ratio.
They demonstrate real expertise there.
But then they're still exposed to these huge, unpredictable natural events. Wildfires, hurricanes, things fundamentally outside their control, maybe even worsening with climate change.
Exactly. Those events can override even the best underwriting in the short term.
So as you think about Arch Capital, or really any insurer, maybe the core dynamic to grapple with is that tension. The tension between, let's say, human skill in managing business risk and the sheer untamable force of nature. It's a constant balancing act, isn't it? Part skill, part chance. Something to keep in mind.